welcome back. So, towards the end of the last lecture, I introduced the concept of money markets. Money markets are those markets in which we have lendings and borrowings and trading of financial instruments with maturities of one year or less than 1 year. So, they are short term instrument trading marketplace, or we have lending and borrowing of money of maturities of less than or equal to 1 year. And now, the participants in the money markets, we have the Reserve Bank of India, we have commercial banks, financial institutions, FIIs for foreign institutional investors, mutual funds, brokers and large corporate houses. Typical money market instruments, well, the most important are the treasury bills. We shall talk briefly about them. Cash management bills, call money market, that is a segment of the money markets where short term trading between banks of lending and borrowing of money takes place. We will come back to it. Certificates of deposits, instruments issued by banks and financial institutions, negotiable instruments. Commercial paper, which are instruments usually issued by high credit worthy corporate houses and privately placed with banks or financial institutions. Again, we will come back to them. Commercial bills, collateralized borrowing and lending obligations, repos, reverse repos and swaps. So, before we get into that, I also introduced the concept of the various yield measures that are relevant to money markets, to investments in the money markets. Let us recap some of them. Before I get into that, the instruments that are traded in the money markets are of two types. One are the discount instruments, where the instruments are issued at a discount to face value and they are later on redeemed on the maturity date at face value. The other type of instruments are the conventional instruments, which are issued at face value and redeemed at face value plus the interest payable for the period of holding thereon. The yield on now, before I get into the measures of yield, let us recap on what exactly we mean by a yield. Now, the yield on an investment is usually measured in terms of the appreciation of the value of the investment per unit of money, per unit of investment, per unit of the worth of investment, and secondly per unit of time. So, there are two normalizations that are carried out when we convert the appreciation in value into a yield. That is, firstly we convert it to a per unit of money basis, and then we also convert it to a per unit of time basis. So, normalization in terms of money and normalization in terms of time. Two types of normalizations are carried out when we define a measure of yield. Now, based on what measure of normalization, the approach to normalization that we adopt, the yield measures in money markets are divided into four measures. Let us recap these four measures. The first is the discount yield. The discount yield is more applicable to discount instruments like the treasury bills, and therefore, it is sometimes called the T-bill yield. In this case, the normalization with respect to money, that is when we compute the return per unit of money, the normalization or the division of the denominator is the face value of the instrument, it is the redemption value of the instrument rather than the initial value of the instrument at which the position or the investment was made. So, that is one speciality of this particular measure, and the second speciality is that normalization with respect to time is carried out on a 360 day year basis and not the 365 day year conventional basis. And the third feature of this particular measure of yield is that it is computed on a simple interest basis. No account is taken of compounding of interest. So, these are three special features of discount yield. The money normalization is carried out with respect to the final value of the investment, and the time normalization is carried out with respect to a 360 day year. Then we have the holding period yield. In the holding period yield, the money normalization is carried out with respect to the initial value of the investment, the amount at which the investment has been made, the entry value of the investment, and there is no normalization with respect to time. In other words, it is the actual yield for the period of holding without any extension extrapolation to an yearly basis. So, that is one drawback in fact of the holding period yield, but it gives you the appreciation of wealth per unit of money, appreciation in the value of the investment per unit of money, but it is measured only over the period of holding without any annualization. Then we have the effective annual yield, which takes into account, or which considers all the three short backs of the discount yield. It uses money normalization with respect to the initial value of the investment, as indeed it should be the entry value of the investment, the price at which the investment has been taken up, and not on the basis of the final value, as is the case in the case of the discount yield. The second thing is, it also takes into account of the feature that 1 year is equal to 365 days. So, it is normalized with respect to time on the basis of a 365-day year, and in the third feature is that it also takes care of the compounding. Then finally, we have the money market yield. Money market yield involves normalization with respect to the initial value, the entry value of the investment, or the price at which the investment has been made, and however, it normalizes with respect to time on the basis of a 360-day year, and it considers only the simple interest formula, not the compounding factor. So, these are the three specialties. I have tabulated all of them in this slide. These are the three distinguishing factors of the various measures of yield. These are the formula of the various measures of yield. You can easily see that in the case of the discount yield, which is also called the banker's discount yield, which is also called the T-bill yield, that is the yield is being calculated, the yield is being normalized with respect to the face value, which is the final value of the treasury bill, the redemption value of the treasury bill, and on a simple interest basis. Holding period yield, also the formula is more or less the same, except that the normalization is with respect to the entry value of the investment, the price at which the investment is made, rather than the redemption value. The expected annual yield, as you can see, is takes care of the 365-day year factor. It is all annualized on the basis of a 365-day year, and it also takes care of the compounding of the returns over the period, over the annual period, which is of 365 days incidentally. The money market yield computes the annual yield, that means the annualization is done, but it is done on the basis of a 360-day year, I am sorry, 360-day year, and it is done on a simple interest basis. So, these are the special features. This slide brings to you the relationship between the money market yield and the discount yield, and this slide brings to you the relationship between the discount yield and the annual effective yield or effective annual yield. The computation of this formula are pretty much straightforward algebra, and so we will not devote time to this. Let us move on to money market instruments. Now, here again I will not devote too much time to this, primarily reading from the slides that follow, because there is little to explain, and secondly this is not the thrust area of this course. So, just for the sake of completeness we will go through the salient features, the very special features of this money market instruments. The first instrument is the treasury bills. Treasury bills are short term instruments. They are auctioned by the Reserve Bank of India on behalf of the central government. The performance or the redemption of the treasury bills is guaranteed by the central government, and these are short term instruments which are issued by the central government, auctioned by the Reserve Bank of India on behalf of the central government to tide over short term liquidity shortfalls in the treasury, government treasury, central government treasury. They are zero coupon bonds, that means they are issued at a discount and redeemed at the face value with no intermittent coupon payments. They are, I repeat, they are issued at a discount and they are redeemed at face value without any intermediate coupon payments. So, the difference between the discount and the face value, which is the redemption value, constitutes the return to the investor, and it is called the discount. The T-bills can be are issued in denominations of INR to 25,000, and investments can be made in multiples of INR 25,000, and multiples thereof. Presently, the instruments are issued with maturities of 91 days, 182 days and 364 days, and the auction is done by Reserve Bank of India on every Wednesday. The 91-day T-bills are auctioned every Wednesday. The other two T-bills are auctioned at every alternate Wednesday, with alternation between the 182-day T-bills and the 364-day T-bills. Major participants in the T-bill market, there is the Reserve Bank, the state governments, the Central Bank of Nepal, commercial banks, financial institutions, mutual funds and primary dealers. What are primary dealers? I will come back to it in a minute. Cash management bills are similar to treasury bills, but they have maturities of less than 91 days. So, very short term instruments which are issued by the central government to tide over very short term liquidity crisis are called cash management bills. Then we have certificates of deposit. Certificates of deposits are negotiable money market instruments which are issued by commercial banks and financial institutions, and they are issued to the public for raising funds by these entities, the issuing entities, which are commercial banks and financial institutions. They are tradable time deposits in a sense, with maturities ranging from 7 days to 1 year. Now, CDs can be issued by scheduled commercial banks, excluding regional rural banks, RRBs, and financial institutions. As I just mentioned, they are issued in denominations of rupees 1 lakh and multiples thereof, and as I mentioned, they can have maturities ranging from 7 days to 1 year. Financial institutions can issue CDs for a period of not less than 1 year, not exceeding 3 years, and CDs can be issued to individuals, corporations, companies, trusts, funds and associations. Call notice term money, these are segments of the interbank market. They are all different segments of the interbank market, where banks lend and borrow amongst themselves to tide over short term crisis arising from shortfalls in the CRR requirements of the Reserve Bank of India, and they are borrowings of a short period. Call money relates to overnight funds, borrowing or lending between banks for overnight periods, that is up to the next day, 1 day. For borrowings up to 2 days to 14 days, from 2 days to 14 days, that market is known as the notice money market, and for larger maturity borrowings and lendings, the market is known as the term money market. The maximum borrowings or the maximum period for which borrowings can be made in this particular market is 1 year. The important feature of this particular market is that no collateral security is required for borrowings in these particular markets. No collateral securities are required for borrowings in these particular markets. Primary dealers are also active players in these markets, and banks can borrow from primary dealers in these markets to meet their CRR requirements, as I mentioned. In fact, this is the main reason why banks approach the call money market when they find that their CRR is turning out to be short of the RBI requirements or RBI guidelines. They approach the banks which have surplus of funds and borrow money for very short periods of time to tide up their CRR requirement, to meet their CRR requirement, and thereby avoid default on this issue. Now, what are primary dealers? Primary dealers are registered entities with the Reserve Bank of India who have the license to purchase and sell government securities. They are entities who buy government securities directly from the Reserve Bank of India under the auction, usually carried out on the National Dealing System (NDS), and these securities are then sold by the primary dealers, offloaded by the primary dealers in the money markets to the money market investors. Primary dealers act as market makers for government securities. In other words, they provide quotes for both way quotes for the purchase and sale of government securities, and thereby provide liquidity to the they are in fact the primary objective of registering primary dealers is that they create some kind of a liquidities for the government securities by providing two-way quotes at all points of time. Registration licensing of primary dealers is done by the RBI. Participants in the call money market, we have the Reserve Bank, the scheduled commercial banks, cooperative banks, land development banks and primary dealers. Borrowing limits in call markets, well, it is given here. Scheduled commercial banks can borrow up to 125% of their capital funds, cooperative banks can borrow up to 2% of their aggregate deposits and primary dealers can borrow up to 225% of their net owned funds. As far as the lending limits are concerned, scheduled commercial banks can lend up to 50% of capital funds, cooperative banks have no limits to the amount they can lend and primary dealers can lend up to 25% of their net owned funds. Then we have commercial paper. Commercial paper are unsecured short term promissory notes issued at a discount by creditworthy corporates, primary dealers and all India financial institutions. So, they are negotiable instruments which are issued at a discount usually by corporates, although primary dealers and financial institutions also have the right to offer commercial paper. This particular instrument is usually privately placed, it is not issued as a public offer. The eligibility for a CP issue, corporate should have a tangible net worth of not less than 4 crores, sanctioned working capital limit from a bank or a financial institution. Number 3, the borrower account should be a standard asset in the lender's books. That means there should be no default as far as the borrower account is concerned. It should not be classified as a non-substandard asset or a non-performing asset. The issue should be rated not lower than P2 by CRISIL or equivalent rating by other rating agencies which are approved for this purpose. So, let me repeat, a corporate should have number 1, a tangible net worth of INR 4 crores or more. Number 2, sanctioned working capital limit from a bank or a financial institution. Number 3, the borrower account should be regular, that is, it should be a standard asset in the books of the lender. And number 4, the issue should be rated at not lower than P2 by CRISIL or equivalent rating by other approved agencies. Maturity of the CP should not be less than 7 days and should not exceed 1 year, although it is usually between 3 and 6 months. CPs are issued in denominations of rupees 5 lakhs or multiples thereof, and CPs can be issued to individuals, banks, corporates, NRIs, FIIs, etc., although they are usually privately placed. Commercial bills now, commercial bills or bills of exchange. Bills of exchange are also negotiable instruments. They are instruments, or they are a bill of exchange is a unconditional order which is drawn by the seller of goods, who is called the drawer, in instructing the buyer of goods, who is the drawee, for the value of goods or the amount of money which is to be paid to or to the order of the seller or the drawer of the bill. This bill is usually sent to the buyer of the goods either through a bank or directly, and the buyer of the goods makes an unconditional acceptance of the bill, which when the seller receives the unconditional acceptance on the bill of exchange, he releases the documents of title to the goods to the buyer, on the basis of which the buyer can take physical possession of the consignment. So, this is the standard procedure that follows insofar as the bill of exchange is concerned. When these bills are discounted with the bank by the seller of goods, these bills are termed as commercial bills. So, let me quickly repeat once again, a bill of exchange is an instrument, it is a negotiable instrument which is drawn up by the seller of goods in favor of the buyer of goods, instructing the buyer of goods or making an unconditional order on the buyer of goods to pay a certain sum of money to either the seller of goods, that is the drawer of the bill, or to the order of the seller, to any other party at a certain point in time which is specified in the bill. The buyer of the goods, when he receives the bill, either through whatever channel it may be, makes his unconditional acceptance thereon, and which is again returned to the seller of goods. On receipt of this acceptance, the seller of goods makes the or forwards the documents of title to the goods to the buyer, and the buyer can claim physical possession of the goods from the transporter. Collateralized borrowing and lending obligations. The collateralized borrowing lending organization obligations is a money market segment which is operated upon, which is administered by the Clearing Corporation of India. The objective of this segment is pretty much similar to that of the call money market, except for the fact that entities that are not eligible to borrow in the call money market can approach this segment. However, in this segment the borrowings can be taken up, or the party can borrow only against the collateralized security of eligible instruments, eligible collaterals. Participants in the CBLO market, entities who have either no access or restricted access to interbank call money market, nationalized banks, private banks, foreign banks, cooperative banks, insurance companies, mutual funds, primary dealers, NBFCs, large corporate houses, provident and pension funds. So, these are the participants in the CBLO market, which is administrated by the Clearing Corporation of India, and where borrowing by these entities can be taken up, but only against the security of eligible financial instruments. Then we come to repos and reverse repos. Repos are basically repurchase transactions where usually a bank who is short of funds to meet certain obligations approaches the Reserve Bank of India for liquidity, for funds against the sale of specified or eligible securities, with the condition or with the agreement to repurchase the same securities at a later date. So, it is a two-way agreement whereby in the first point in the first leg of the transaction, the bank who is to borrow sells the securities to the Reserve Bank of India, and Reserve Bank of India replenishes funds to the borrower. But there is also a second leg of this agreement which is also agreed upon at the same point in time at which the initial agreement is entered into, and that is that at that future date the commercial bank or the borrowing bank shall repurchase the securities at the predetermined price from the RBI. So, it is a two-way transaction. First the borrower sells the securities to the Reserve Bank of India, and then the Reserve Bank of India sells the securities back to the borrower. The difference between the two prices would naturally constitute a return to the lender of money, that is the Reserve Bank of India. If this transaction was to operate in the reverse direction, then it would be called a reverse repo. So, in the reverse repo what would happen? The Reserve Bank of India would would borrow money from the commercial bank against the sale of securities, with the undertaking to buy back those securities at a later date at a predetermined price. The return on the repos is usually referred to as the repo rate. Okay, so that is as far as these instruments are concerned, money market instruments are concerned. I have given a brief capsule of the features, the salient features of money market instruments. As I repeat, this is not the thrust area of this course. We now come to one of the major thrust areas of this course, which is bond analysis and evaluation. So, let us start with the definition of a bond. What is a bond? A bond is a legally binding agreement between the borrower, the bond issuer, and the lender who is the bond holder. This agreement, so there is a binding contract, enforceable contract between the borrower and the lender, which is represented by the bond, and the agreement specifies the principal amount of the loan, the size and timing of the cash flows in dollar terms, that is the cash flows may be, or the return on the bond or the interest on the bond may be specified either in terms of a particular percentage of face value, we will come back to it, or may be tagged to a particular economic variable like the LIBOR or whatever the case may be, MIBOR, LIBOR or so on, or certain other interest rates which are commonly used in these markets, bond markets. But the important thing is either the rate is fixed or the rate is floating. Floating in the sense that it is tagged to the value of another variable, market influenced variable, economic variable, and it's the interest rate may change from one period to another, in which case it is called a floating rate. Some terminology: maturity. The maturity is the point in time at which the bond is redeemed, or the principal on the bond is repaid. That is the point in time at which the bond is called the maturity, is said to mature, or the date of expiry of the bond, date of maturity of the bond, as the case may be. The time interval remaining between today and the date on which the bond becomes payable or redemption is called the term to maturity. The face value of the bond is a very interesting term. It is the nominal value of the bond as specified in the contract of issue. The importance of face value is that it is a constant parameter with respect to a particular bond. The amount of interest and the amount of repayment is fixed with reference to the face value. This face value provides the reference. Please note this fact that the face value is not identical with the price of the bond. It may or may not be identical with the redemption value of the bond. It is a reference value, with respect to which the interest payments are computed. It is a reference value with respect to which the final redemption value of the bond is computed or is usually given. So, this is a very important feature, the important thing to note, that face value is not necessarily the exact redemption value or the price of the bond. It is a certain benchmark, a certain what you call standard value which is mentioned in the contract of issue, which does not change for a bond. It is a fixed value with respect to the bond, and it is with respect to the face value that we actually calculate the actual cash outflow, because the coupon rates or the interest rates on the bonds are usually quoted in terms of percentages. So, when we have to convert these percentages to actual money value that has to be paid on account of interest, it is done with reference to the face value by multiplying the coupon rate and the face value. Similarly, the redemption value is given in terms of the face value, whether it is above face value, 50% above face value, or 10% above face value, or 10% below face value, or at face value, but the reference point is the face value of the bond. Coupon rate is the rate of interest, that is the nominal rate of interest that is specified in the contract of issue. It is not the market rate of interest. Please note this point. Coupon rate is not the market rate of interest. It is the rate of interest at which the bond is issued in the first instance by the issuer. It is fixed by the issuer. It is not. It may relate to the market. That is a separate issue, but it is not obliged to be the market rate or a certain fraction or a certain add-on of the market rate. It is not necessarily so. It may or may not be so, but it is fixed by the issuer. It is not fixed by the market, and the coupon rate is the nominal rate of interest. It is the contractual rate. It is the rate that is given in the contract of issue of the bond, the issuing document, that say 6% per annum is the coupon rate. That means if the bonds see if the interest is paid annually, and if the bond is of a face value of 1000 rupees, then that means you will get 60 rupees or 60 INR at the end of each year. So, that is how the coupon rate is computed, or that is the relevance of the coupon rate. Then we have the frequency of payment of interest, frequency of payment of coupon rate. Usually bonds in India have semi-annual coupon payments, although this is again not mandatory. The coupon payment or the interest payment may be annual, may be quarterly, or maybe even monthly. Usually in the context of India, corporate bonds make interest payments on semi-annual basis. So, that is called the frequency of the interest payment or frequency of coupon payments. Now, premium, par and discount, as I mentioned, the coupon rate is the rate which is fixed by the issuer of the bonds. Now, depending on what the market rate of interest is, a bond may be quoting, if the bond is trading in the market, a bond may be quoting above its face value or below its face value or at face value. We will come back to it in a future slide, but basically the relationship between the coupon rate and the market rate will tell you whether the bond is quoting in the market at above face value or below face value. For instance, if the coupon rate is more and the market rate is less, then the bond is naturally likely to quote above face value and it is called a premium bond. On the other hand, if the coupon rate is less and the market rate is more, then the bond would be quoting at a discount and it is called a discount bond or a bond quoting at discount. A bond which is quoting at its face value is called a par bond. Now, I repeat once again that the redemption of the bond, redemption of the instrument need not necessarily be at its face value. The redemption proceeds of a bond or the redemption value of a bond need not necessarily be its face value. It is not legally required. A bond may be redeemed at above face value, a bond may be redeemed at below its face value, and usually if it is redeemed at a above face value, we call it a bond which is redeemed at a premium. If a bond is redeemable at a discount to face value, it is called a bond redeemable at a discount, and a bond which is redeemable at face value is called a bond redeemable at par. So, maturity and term to maturity I have already explained. The maturity date of a bond is the date on which the principal of the bond becomes repayable, and the time lag remaining between today and the date of maturity of the bond is called term to maturity. Now, classification of bonds by maturity, well, usually bonds which have a maturity of 1 year or less or instruments which have a maturity of 1 year or less are traded in what are called money markets. We have already talked about that. Bonds which have maturities of more than 1 year and less than 10 years are usually called notes, and bonds which have a maturity of more than 10 years are usually called bonds. So, although in India we normally talk about instruments which have a maturity of more than 1 year as bonds, technically instruments having maturities of more than 1 year and 10 years are called notes. Face value I have discussed in a lot of detail. So, face value is that value which is the nominal value in the given in the contract, and on the basis of which the actual outflow or actual payment of in dollar terms or in rupee terms, in money terms, is computed by applying that interest rate, the coupon rate, to the face value, and it also determines how the redemption value is to be calculated, the amount of the redemption value. So, I have discussed the issue of redemption at par and premium and discount. Bond quotation, bonds are usually quoted on the basis of the amount of money or the value per 100 of face value. So, if a bond has a is being quoted at 98 for example, and it is a bond with a face value of 1000, that means the value of the bond is 980. So, the quotation of the bond is with reference to 100 of face value, per 100 of face value. So, if a bond is quoting at 95, that means that the value of the bond, if the face value is 1000, the value of the bond is 950, and if the face value of the bond is 10,000, the value of the bond is 9500. So, I repeat, the quotation of the bond is with reference to 100 units of money as the face value, and the quotation is given with reference to face value is normalized with respect to 100 units of face value. We will come back to further talk about the bonds after the break. Thank you.